Hi, and welcome to WalkerTalks, the Walker podcast, where we talk about real estate and real estate adjacent subjects. I am Manon Fredette. I will be your host for today, and I'm pleased to introduce you to our very special guest, Chad Robinson.
Awesome. Thank you.
Thank you for joining us, Chad. I appreciate you taking the time out of your schedule to do this.
My pleasure.
Chad is a professional of many fields. We're going to be talking about a bit of everything that he's been doing. He is a father. Mm-hmm. He is a husband, a dear friend of mine and my family. He is a real estate investor, a mortgage broker, a real estate broker. You deal with private lending. You are a podcaster. You are an author. I mean, honestly, is there anything you don't do?
I just don't sleep.
I could see that.
I just love real estate, right? And everything about it. It just makes me, since I was a little kid and my family's been in real estate forever. So it's all real estate all day, every day, and pretty much all the aspects of it since I've been a little kid. So I love it.
Yeah, you actually grew up in the industry. Your mom owned a brokerage, so you...
She did. I remember as a little kid going into her real estate office, and they used to use carbon paper between the offers to write offers. And now people don't even write offers anymore, right? It's just email and e-sign. But back then, your hands would get all blue, and I thought it was the coolest thing as a kid dealing with this stuff.
Getting in trouble around the brokerage.
Oh yeah, absolutely. And back then, we forget now, but with the internet and everything, you can see a new listing in seconds. Well, the real estate offices had to get hot sheets delivered every day to them of the new listings that would be coming out, and it would take weeks before there was like a phone book that used to go around to all the realtors. And I remember my mom sitting in the kitchen table highlighting listings that she would want to show her clients back in this phone book. It was and she kept them for years and years and years. We had like shelves of them.
Mementos from the past.
Pretty much, right? It was like, how things change.
Well, did you know right from the start that was the field that you'd be pursuing as an adult, or was it, because I know you've pivoted a couple of times too throughout your career.
I did. Funny enough, the opposite. I'm like, I am not going into real estate. I'm not going into real estate. There's no way I'm going into real estate, right? Because kids rebel against what their parents are doing. And then I'll never forget it. I started selling real estate part-time when I turned 18, when I was going to university. And I said, why have a part-time job at whatever was $3 an hour? And I said, I can just go sell a house. And like, hey, why the hell not? So that's how I started selling, put myself through university by selling real estate in the summers and March break. And then I was all excited when I graduated, like, I'm going to go get a big corporate job and do all this stuff. And the job offers I was getting was less than I was making in the summer selling real estate. I'm like, yeah, this doesn't compute. You want me to work 50 hours a week and
for tiny money.
For tiny money for less than I'm making in 2 months of the year. Yeah, my brain, just the math didn't work. So then I got into real estate and started selling real estate, opened my own real estate brokerage. And back then, in order to become a mortgage broker, you had two choices. You had to either become a real estate broker or move to Toronto and go to Seneca College for 3 years. I'm like, well, I'm an Ottawa boy. I really don't want to move to Toronto. So I got my real estate brokerage license and quickly realized that I much prefer the finance side of the game than the real estate side of the game. And then opened up my first mortgage brokerage, 20-something years ago, and haven't really looked back.
And since then, have you found that you're still going back and forth, or you're 100% into the finance world now?
Well, I'm really 100% of the finance world, and now even more specialized just into the private space and structured debt. But we've built properties, I've severed properties, we've done renovations, we've done flips, we've done Airbnbs, we've done all kinds of stuff. I love all the aspects of real estate. I don't really enjoy the marketing and the sales aspect of it, but I love helping people, coaching people, helping them structure deals. Would I run a real estate brokerage again? No. I much prefer the numbers side of the business.
Absolutely. And it is also a family business. Your wife also joined you in there throughout the years. I'm good friends with your wife too, so I'll give her a plug. Good job.
Yeah, absolutely.
Good job, Muriel. But I know that you have been dealing with a lot of different cases. I mean, the market has been changing so much, a major shift over the years. Do you find that it has impacted your industry significantly? Has there been a lot of changes, things that consumers should be made aware of?
Absolutely. So markets always cycle, and everybody forgets this, is that, what we're going through right now, higher interest rates, when the market was crazy hot and then followed by a downturn, a kind of very quick downturn, the market flipping like that. This has happened time and time and time again. And so if you're prepared for it, there's lots of opportunity. And people freak out, I'm not going to sell my house now. Well, now is actually not a bad time. We're back to more of a balanced market. I mean, you can probably comment more on that.
Absolutely.
People can take a breath and decide, should I buy this house now? It's not selling in 35 seconds. You don't need to, sign an offer in the back of a car, which was just ridiculous.
No, there's time to breathe. We're seeing conditional offers come back into play. People have time to actually set up their financing, although you should be set up before you start shopping.
Yeah.
And then continue on, do a home inspection. My goodness, something we hadn't seen for a while.
Absolutely, right? So these kind of things are more normal, and we just forgot it in the last couple of years. So I've seen, interest rates now coming back, we're 4 or 5% interest rates. So people it's a little bit higher. We're not used to it. We were used to 1%, 2% mortgage interest rates, but this is the norm. If you look back over history, it's really the normal kind of interest rates.
But then because we're not used to it, like you said, it is breaking people's back a little bit more, and therefore we're seeing a little bit more of a creative side to the financing industry.
Absolutely. And so that's where being in the private space, which is where I'm in now, what I love. I love creating unique situations for people and helping them out in unique deals. And one thing I see a lot of happening is something that many realtors, we used to call it vendor take-back financing. Now it's usually called seller take-back financing. So this is when the homeowner selling the house gives a mortgage to the buyer. Sometimes it's a whole mortgage, sometimes it's a first mortgage, sometimes it's a second mortgage. But that is coming back. And originally, back in the day, this is why realtors were allowed to be licensed as mortgage brokers, because it happened so often that the realtors negotiated the terms of the mortgage and the terms of the interest rates and how the length of time.
Yeah, we saw this more maybe in the 80s when we saw the rates climb up to what we are paying for a credit card.
Absolutely.
Nowadays.
Yeah, they were 18% at one point.
Wow. Yeah, I can't.
Could you imagine? It's like buying a house on a Visa. Like, it would be nuts.
Yeah, that would be pretty scary, actually, to come in as a consumer at that point.
Yeah.
But now we're seeing these vendor takebacks come into play. Now, just for the viewers here who are joining us, is that something that you don't benefit from it financially? It just helps you move your property at the end of the day?
From the seller's perspective,
Correct.
no, it actually does a couple things for the sellers. So this is really, really common in investment properties and commercial properties. It's been happening still all the way along, but it's coming back to the more residential market. So the seller, let's use the example of an estate or somebody that has no mortgage on a home and they want to sell this home. And then the first thing that the sellers often say, well, great, I'm going to sell this house, but what am I going to do with this money? I got $500,000. Okay, what am I going to do with it? I'm scared of the stock market. I'm nervous. I don't want to go buy another property. So one of the options is that you lend this money back to the borrower. They should still go through a credit application through a professional like myself.
Absolutely. It's not just good faith.
Exactly, right? And there's a whole bunch of legal processes to go through, but to make sure that they're worthy of having this loan and can afford it. But now the seller becomes the bank. And they're earning that 4, 5, 6, 7, 8, 10% interest instead of the bank. And of course, if the borrowers don't pay, they have all the rights of a mortgagee, which means you can, foreclose on the property or power sale of property and sell it and those kind of things. But it gives the person an income that's selling the property, which a lot of in the senior side is something desperately needed. They need income.
Absolutely. And this is something that would be generated over the course of many years, as most people take several years to pay off their houses.
Absolutely. It also, if you have an investment property, it also has the ability to defer some of the capital gains. So this is why you see it very often in investment or commercial, because if you're lending a mortgage to the buyer, instead of paying all the capital gains in that year, you defer some of it for future years.
That is smart. That's a good tip for people out there to keep in mind. And now that after, like, let's say you put in a 5-year term, then that vendor would renegotiate the terms just like a normal bank, I assume. At
Absolutely. And I usually don't recommend VTBs for that length of time. Usually they're 1, 2, 3 years, often to help a borrower, they're transitioning jobs, or maybe the property is in rough shape, something like that. So then they can get a more conventional mortgage in a few years. But, and it also tied up with what that person selling wants. When do they think they'll need the money?
True. And do you find that for most vendors that are lending out their capital here, do you find that it's a high risk for them, or just obviously there's always risk involved with investing, but is it fairly safe, or?
So real estate, in my opinion, is relatively safe in the first place, and mortgages are relatively safe on the spectrum. I know real estate. I love real estate. You know real estate. You love real estate. Every time I've put money in the stock market, I've lost money. So I've learned, don't do that. Some people make billions of dollars doing it, and they're experts at it, right? We're experts in real estate. So I think with the right credit application, the right borrowers, it's not risky. The key is the right down payment that they put in and the right borrowers. Are these people, can they afford the payment? That's the biggest thing.
That's a big one.
It's a big one. And a lot of people think, oh, I'm just going to do a VTB. And, they can't qualify for it at all. So when you ask them, how are you going to make this payment? And they have this blank look on their face, I'm like, yeah, that's not a good sign.
And do you find that most people that do those will be paid out as a regular mortgage, or do you find that there's a lot of cases where it'll be like, I'll pay you the lump sum in a couple of years? Or I guess that's more commercial versus residential.
Great
that might
question.
Have differences like that.
So no, it's a fantastic question, Manon. Is often the real estate investor that's trying to create some really funky financing situations want to do lump sum payments in a year or two. I never recommend that. And the reason why is you don't know if there's a problem for
Correct.
2 years.
That's right.
But let's say, I'm just going to pick up a number. Let's say the mortgage payment's $4,000 a month. You could say, I'm going to pay $2,000 a month and then the rest of it at the end. So at least there's a monthly payment coming out every single month. So the borrowers also don't forget that they have a mortgage.
Correct.
Because if you don't have a payment for 2 years, then you're like, oh my God, I didn't save for this. And yeah, it's
easy to lose track.
It's easy to lose track. A lot of B lenders, so in the finance world, there's A lenders, B lenders, and then privates. So the B lenders are these companies that are more flexible, they deal with people with bad credit or those kind of things.
Higher rates normally associated with that too, for the higher risk.
Exactly. They usually insist on them collecting the property taxes. And the reason why is the number one reason for default in these lenders isn't the monthly payments, it's getting behind your property taxes. Because the borrowers aren't saving for the property tax and they get this bill, $5,000, and they can't come up with it.
Makes sense.
Yeah.
I mean, hindsight, right? If you don't see it, it doesn't hurt you until it's in front of you
right?
at that point. And again, if you're looking at it, you just mentioned the B lenders, and then you're kind of going into the private lending. Do you find that it's a different beast altogether?
Yeah, so private lending is it's a short-term solution. We're 1 to 2 years at most, generally 1 year. And it's here to fix a problem. So we just recently closed a file this week. Actually, funny enough, it was another realtor that bought it. It was a house. It was a hoarder house. The house didn't even have a furnace in it. And
that is quite rare here in
right?
Ottawa.
Yeah, the house was, in Ottawa, exactly. It's cold here, but the house...
I mean, unless it's baseboard electric or...
No, this was supposed to have a furnace. It was removed.
All right. That is very unique.
Right? So the bank wouldn't finance it. It looked horrible, no furnace. Obviously, the water was shut off, thankfully. So they came to us for a 3-4 month bridge loan. So we closed it. Obviously, it's higher rates. So mortgages and private lending are here for a solution. So the exit strategy on that is quite easy. They're going to put a furnace in, and they clean it up, and then they're going off to Scotiabank or TD Bank or whoever. So our money's used for a very short period of time. The other thing you'll see with privates is people, job losses or transitioning between jobs is a big one. Somebody's divorcing. They don't quite have their divorce agreement finalized, so the banks won't touch them until that happens. That's been a common one. Credit. Sometimes, quite often, it's a weird trick with math and the credit bureaus, but if you had $100,000 in credit cards, your credit score might be really low. But if you take that same $100,000 and apply it onto a mortgage and pay off your credit cards, well, now you have no unsecured credit and your credit score goes way up. So just moving it kind of from one pocket to the other can have a huge impact on your credit rating. Well, of course, you still got to qualify and make your payments, but that's a short-term strategy often used by mortgage brokers to fix these clients' credit, and then you can bring them back to a TD Bank or a Scotiabank 6 months later.
Just polishes off their file.
Exactly, yeah.
Okay. Well,
so those kind of strategies.
Well, I mean, they're important to have in play, especially if you need to get a little creative in a harder market where it's harder to secure money.
Absolutely.
Do you find that there's a major difference between vendor take-back and mortgage assumptions? Because that is something that the Ottawa market hasn't seen in a long time.
Absolutely. Great question, too. So most lenders, I'd say probably 90% of the lenders or more, have a clause in it that you can assume somebody's mortgage. And most realtors don't know what that is. They don't know how to deal with it. And most bankers at the branches won't know how to deal with it because they haven't been around since the last assumption was been done.
Which would be...
Yeah, right? So let me get into it. So an assumption is basically the seller has a mortgage, let's pretend with RBC, and it's at 2% or 1.5% interest, and there's 3 years left on this mortgage. It's a great mortgage. Now that same mortgage is 5%. So it's like, wow, I really want to have that mortgage. So you apply to RBC to take over that mortgage. So you literally... they delete the seller's name, they go on the computer and they input the buyer's name. You still have to be approved.
Of course.
In Canada, it's mortgage assumption with approval. Okay. In the States, it's mortgage assumption without approval, which is really interesting.
That is a bit risky for the lender.
Absolutely. So in the States, it's a completely different world. So if you're hearing American podcasts and stuff and they're saying, no, just do it, I'm going to assume the mortgage. Here, you still got to qualify. And the benefit is that you're getting that lower rate.
Now, do you have to qualify with today's terms or do you have to qualify at the terms that the original purchaser qualified for?
Yeah. So you know what? That's a really good question, and I'm not sure. I would really think it's very lender specific, but it'd be qualifying at the 1.5% that mortgage was done at, and probably what's called the MQR rate, which is today 5.25%, which is still way less than what you're qualifying today.
And for most people, this would be part of the mortgage, not enough to cover the whole amount. They would still have to secure a second loan at that point, but they'd have options to either go see a B lender or a regular bank, or look at a private investor at that point, I assume?
They might. So depending on when this mortgage was put in place in the first time, so they might have enough cash for the down payment. If they bought this house 2 years ago and they financed it 95% 2 years ago, it still might be roughly the same balance. The seller, it's an advantage because the seller's not paying the 3 months interest penalty.
Correct.
To get out of it. And it becomes an incentive to sell this house.
True.
So why would I choose, right, as a dual. So why would I choose this house versus this house? Well, if this house is offering me a 1% mortgage and this one's a market rate's at 5%, well, that's a big difference on $400,000 or $500,000.
It's a lot more money in your pockets at the end of the month that are kind of coming through.
All right.
Do you find that there's a significant risk factor again for those people that would be giving their mortgage to the new buyers?
So there shouldn't be. If the bank is doing it correctly, the bank will release the seller from the mortgage. And that's the important thing for the sellers, is to make sure that they're fully released. And once they're fully released, they're fully released.
So if the new owners were to default on anything, then their hands are clean. They're not tied to this property. There's no recourses against them directly.
Correct. But it's important for the sellers to make sure that they have that full release. Some banks might not give it, or it might not be their policy. It should be. But again, most people in the branch won't even know how to do this.
Okay.
So the sellers will, if you want to do this, and I say this to all the realtors and the sellers out there, is talk to the branch, talk to the sales force, the person that has experience doing it, find the procedures, get the fax numbers if they're faxing or whatever, right?
People
what is
fax?
a fax number? Yeah, I know. It's back to 1995. But it's important to get that right person, because the people of the branch will have no clue.
Well, it's good information to have. Now, I'm also curious. I know we've done some, but again, I would like everyone to be aware of it. Private lending, like that is, for a lot of people, it's a bit scary, the idea of becoming the bank, which in fact is pretty much the name of the title of your book, Becoming the Bank. Give you a little plug here.
Yeah.
Great book. I recommend it for everyone to read. So this one here, just if you're looking to become an investor, putting out your money out there. I know a lot of people might think, like, maybe I don't have enough. Like, do I need it to build a portfolio? Do I need to gather a group of friends and, all of us chip in money? What would be your recommendation for people looking at this with fresh new eyes? Absolutely.
So private lending has been happening forever, right? Going back to, like, I kind of joke, right? Back to Babylon times, I mean, people have been doing private loans forever. And in mortgages and real estate, again, it's been really normal. Farmers typically were giving loans to other farmers to buy more land, going back, really since forever.
Yeah, no.
So private lending in the modern times went away for a little while as an option because money became so cheap. It became so easy. The banks for a while were giving money to everyone.
Well, it makes sense. We just came out of that. Now we're all suffering for it.
Absolutely, right? And back in 2008 in the States, you had a pulse, you had a mortgage. So now it's coming back to having an opportunity to lend again. So private lending is basically you lending your money to a person privately, secured on real estate, just like a bank would. You have a first mortgage or a second mortgage secured in the bank. If they don't pay, there's recourse. We can take the house back and sell it. Now, we never want to do that, but that is the ultimate option.
That's the last option.
That's the last option. The key is that lending to the right people with the right equity.
And how do you find that out?
So going through a professional, number one, is I always recommend, obviously it's what I do every day. We're just private lenders now. We analyze credit for other parties all the time. There's a lot of other mortgage brokers out there that also do private lending. Mm-hmm. And there's also something called mortgage investment funds. So this is MIX or mutual fund trusts we run a mutual fund trust. But so you can put in, it goes into a pool.
Okay.
So really high level, you have two options. You can either give money directly to one person. Here's 50 grand. I'm going to give you a mortgage for 50,000. You and this borrower. The other option is you put it into a pool, and then the pool lends out to a lot of borrowers. Less risky in a pool, generally, because your mortgage is invested over a bunch of mortgages versus just one. But then you don't have the individual approvals.
Okay.
So you're not determining, should I lend to Janie and Bobby?
And probably less risk is also since you are pooled with other
generally,
or not buyers, but lenders at the same time, I assume?
Yeah, generally. So each pool has a different flavor of what they're investing in. So we run three, actually. One deals with just home flippers. The other one deals with very, very low risk files, obviously lesser rates, and one deals with a little bit more higher risk files, so more second mortgages. And there's lots of others, all kind of different flavors out there. Some people will lend just in Toronto, some people lend just in Ottawa. There's pools that have niches that all over the different kinds of options. So I say to the investors, pick what you like. It's just like buying a mutual fund. When you walk into your bank and they're going to say, invest in this high-tech basket of a mutual fund, or invest in mining companies or whatever. Mortgages are very much the same. You can pick the flavor that connects with you.
It makes sense. I mean, everyone has different risk factor that they're willing to absorb. So it's just like A, B, C.
Absolutely. We have some investors that only want to lend in the GTA area. And again, I have some investors that only want to lend in Ottawa. And some people say, I only want to lend on second mortgages. And we lend out a lot of money for people that are, in their senior years and want very, very low risk stuff. True. So that money usually sits around for a little while until they find a perfect file. And then they get that. And they've been so far, touch wood, very happy.
And do you find that, again, there's always risk involved. The greater risk, the more potential for income to come back to you at the end of the day. But do you find that most people get started, they just pour more into it? Like it's one of those things where you see good results and you keep running?
Generally, yes. So private lenders, what I've noticed is they start small, 10, 20, 30, 40 grand. You can also lend out of any of your registered accounts. So your RSPs, your ESPs, your DSPs, if you have a disability, your LIRAs.
I'm assuming there must be like a cap on that too.
No.
Oh, wow.
Yeah, you have, so we have some people that have left one of the government type of jobs and they have this locked in pension. So that's called a LIRA, locked in registered account. They have hundreds of thousands of dollars in there that we deploy in mortgages all the time.
Yeah, because it's just sitting there. They can't access it for a while. So could make money with the money you have.
Exactly, right. Let it grow. And the TFSAs are a great vehicle for lending private mortgages as well, because once the money's there, it grows tax-free. And they can take it out tax-free.
Oh, good tips, good stuff to know, absolutely. Yeah. Again, you've touched base on this. You are second generation into the business. What pushed you to really get into this? Like, other than seeing your family, like what made you make the decision? You said you like numbers, you felt more comfortable. Like what was the aha moment that made you go like, I'm getting into private lending?
Other than, the private lending specifically was, as a mortgage broker, I was doing it for, a long time, right? 20 plus years. And I was just getting frustrated with the banks. I'd see fantastic files with fantastic people, great jobs, great credit, and getting declined for stupid freaking reasons. And just because there's little check boxes, they're not checking off this checkbox. And so I said, there has to be a better way. And over the years, I've always been lending private money. A little bit has been maybe 10, 20% of my business. And then we finally made the commitment to just make it full time and become an expert at it. And that dovetailed nicely into this market where now private lending is becoming, the golden era of private lending, because the banks are scared. And when banks get scared, they don't lend.
It's true. They tighten their belts up. They're making the files a little bit more difficult to be processed and patched through. So
absolutely. So we become even more important. And so right now, a first mortgage with a private lender is 8, 9% interest rates. A first mortgage with many of the major lenders is 6, 7. So the spread between private lending and the main banks is not really that high anymore. And so some people are like, heck, you're going to ask me 5 questions and they're going to ask me 500 questions. Yeah, I'll pay the extra 2 points.
True. It's just simplicity.
Just simplicity, yeah.
And for most people looking to start investment, do you think that normally you'd recommend a certain, like, don't go in below this or come in with, what should a first-time investor be bringing to the table if they wanted to get into the game?
Perfect. Yeah, another great question. So if you're lending directly in a mortgages now, unfortunately, because of the values of property going up, if you're not lending at least $50,000, it's not worth it.
Yeah.
However, if you want to put your money into a mortgage pool, many of them, like ours, will also take mortgages in or investors in at a minimum of $10,000.
Okay.
So if you have a small amount, you can come into a pool. Also a good way to get your feet wet. If you have larger amounts, you can do both. You can put it into a pool or go direct.
Okay. And where would we find you if someone wanted to get started? What would be the best way to reach out?
Perfect. So if you're interested in private lending, I would just definitely pick up my book. It's called Becoming the Bank. It's on Amazon and Indigo. Really goes through the basics of private lending. So I recommend everybody do that anyway. And that way you get a feel for it. Then if you want to reach out to me, so it's alignmortgage.ca is our company website, and Chad Robinson. So if you Google Chad Robinson and mortgage, I'm on all over the place on the internet.
You're also on podcasts.
And on podcasts, yeah. We have our own podcast called Becoming So we're not becoming the bank. But,
That is the book.
That is the book. So Cashflow Canucks and The Practical Brokers are 2 podcasts.
Perfect. Well, I appreciate you lending us your brain here for a good 25 minutes. Great knowledge, great information, valuable information for all of our
thank
listeners.
you very much.
And again, thank you for meeting with me today. Thank you for being here. You are my first podcast that I have done. So
did you have
great
fun?
honors. Yes. Now I can stop panicking.
No, you did amazing. And it's lots of fun, and you give great value out to your clients, right? I've been seeing you work for years on how you take that care with people and hold their hand and go through all those questions, and especially the investors that are looking to buy investment property right now.
Well, especially if you're starting, it's always so scary getting into the business. So it's nice to have someone that you can rely upon and kind of get that information that you're looking for, because stressful situations, you need someone to help guide you through them. It makes the whole process so much simpler.
Absolutely.
And enjoyable.
For sure.
Well, thank you for joining us, Chad. I appreciate it again. And thank you to all of our listeners for joining in on our podcast today. Feel free to leave a comment. Let us know who you'd like to see next time. And we'll talk again soon.
Thanks.